Thing working? All right. I think we got sound. How's everyone doing tonight? We got to go quick. I don't have a lot of time. So we're gonna blow through Pickles picks pretty fast tonight. But I will at least get some of the news covered. There wasn't well, actually that's not true. There was a whole bunch of shit today, but nothing too crazy. I think we could probably cover it pretty quick, and then I'll get to some of the charts, and then we'll get started on Pickles picks for tonight. For the volatility report, I will post that over on the Discord, and you guys can I'll post it in the announcements channel for everyone. I know some of you guys want that as well. All right, what's up? Since liars and ENT. Second. Give me 2 minutes, and then I'll get this started. All right, let's get started. So we got another bump in oil today. Obviously, stocks fell back a little bit. I would say throughout the majority of the session, we saw put sellers and like the short vol and bulls pushing back really hard to try to maintain parity going into CPI. Most of the positioning into CPI had been built around 77.50 to 77.75. Obviously, cool CPI was going to be the breakout to the new all-time high, push out to 7,800, at least based on the positioning that we saw. But yesterday, some of that positioning weakened. It further destabilized today, and that sort of started to open up the downside a bit. And basically, bulls just got squeezed all fucking day, all the way down to our lows. We closed, exactly where I predicted last night in Pickles picks. I was off by 80 cents, but that's not what's important. Or was it even 80 cents? Hold on. It was yeah. No, I was off by like $1. No. Oh no. I was spot on. I was off by 1 cent. 1 cent. You can fact check it if you want to. Damn. Still terrible. But they got squeezed out all day, but they pushed back against that throughout the entire session. So we got a very slow, like kind of escalator down type movement. Didn't get the 7,700 test. They managed to hold the floor at 77.25. I wouldn't be surprised if things push up in the overnight a little bit, if they're not already. and try to regain the levels they lost during the intraday, moving into CPI, which is in the morning. I told you they would adjust it for you. Yeah, that was awesome. I can't believe I came that close. S&P fell 32 points to 77.2820. Nasdaq lost 60. Dow declined 34 basis points. Breadth was positive in the S&P, which is even weirder. 1.2 advancers for every decliner. So not broad liquidation. Amazon fell 2.1%. Alphabet dropped 3.8%. SpaceX lost almost 4%. So it looks like the short squeeze there might be over. And the energy sector gained about 1.1%. Volume was real light, 15 billion shares against like the 17.8 billion 20-day average. Market assumption is obviously still tomorrow's CPI is going to rescue the weak, payroll narrative and push the September hike odds lower, right? But I would say that's it's nesting right against this escalation we're seeing with Iran and the breakdown of the peace deal that never existed in the fucking first place. But which could end up being more like the June CPI report where CPI fell, but like oil was up at the time. And so everyone was like, well, then the print's fucking meaningless. And this could be really similar to that if oil keeps pushing higher because we're obviously very close to oil squeezing the upside if it's not already doing that right now. Yeah, getting real close to that like 84 mark. And so I would say that there's a fairly good chance that even the expected print, if it's not cooler than expected, even the expected print could pose some problems. And so the asymmetry for tomorrow is a bit weird. Like a soft print probably knocks like the odds lower and helps the front end, but not the top end. And then a hot print says that like the weak hiring is showing up before inflation is under control. And so, the Fed may still choose not to hike because of that. But the long end may just tighten as if they were anyway, which it kind of already is to a degree. 10-year was around 4.72 to 7.3 today. 30-year neared 5.3. And all of the payroll softening in the top end is wiped out at this point. Today's $58 billion 3-year auction wasn't too bad. It stopped through 0.5 basis points through and I think the high yield was 4.291. So buyers are still, so there's still liquidity for absorbing like shorter intermediate duration. But obviously the 10-year auction tomorrow and the 30-year auction on Thursday are going to be far more significant. All three of these settle next Monday, where there's going to be like a $28 billion drawdown from reserves. The funding side looked fine. SOFR was 3.63 for the 10th. Still below IORB. And reserves are still at like 3 trillion. Oil was up. Brent at 88.91, WTI at 83.20. The highest settlements since end of July. So the market's not just selling. Like the oil market, like oil shorts aren't just selling into this, or at least not selling into it hard. They might be stabilizing it, but they're not actively shorting. And so we're probably getting more oil shorts pulling back than we're seeing added. Um, Only 6 vessels crossed yesterday, down from the 10-day average of 11. And that used to be like 125 to 140 prior to the war. Iran's new Supreme National Security Council secretary said today that the strait will remain closed unless Washington changes its behavior and accepts Iranian conditions tied to ending the war, which links the maritime access back to a larger ceasefire, um, and further clarifies that the Omani agreement is not going to be a standalone solution to this. But Bab el Mandeb is also escalating behind all of this. There was an attack on an Egyptian-owned cargo vessel, Tiama, which killed 4 crew members today. 3 Yemeni Coast Guard personnel were supposedly injured by a drone attack while attempting a rescue. And the ship was not Saudi owned or operated, but which somewhat matters. But Kepler said that Bab el Mandeb traffic averaged 32 ships per day for the last week, which is down from roughly 50 prior to the Houthi blockade. So overall, Red Sea traffic is already more than 50% below levels preceding the earlier Houthi campaign. And that affects underwriting quite a bit. Once attacks start killing crew members that are not even vessels that are not Saudi controlled, insurers and like vessel owners have to start pricing in the root risk, and not merely like flag and ownership risk, right? So if they're attacking vessels that are not directly linked to the war, then the insurance costs the flag cost is what country's flag you're flying under, and then the um like the ownership risk is what nationality controls ownership of the boat. Sometimes those are 2 separate things. And generally speaking, if you're from a country that's not directly involved in the conflict in some way, or you're not flying under a flag of one of the countries directly involved in the conflict, you would be considered safe from attack. And this is saying that's not the case, and then that increases broader insurance costs across more fleets. And obviously now it's just going to start being like any vessel in the region is a potential target, which then it starts to drastically increase their shipping costs. And Houthis attacked Aramco's Jazan refinery over the weekend, which produced a fire that the Saudis said they extinguished without casualties. And that's I think that's that the Jazan goes through about 400,000 barrels of oil a day, and is in the same Red Sea system, where Saudi Arabia needs while Hormuz is impaired. And that attack came after the security defense pact between Turkey and Pakistan. Houthi media said the group attacked a Saudi vessel carrying military equipment in Bab el Mandeb, but no confirmation from Saudi Arabia on that. And the market's obviously pricing in that the Saudis' western export route through Bab el Mandeb is going to help temper the increase in oil costs due to the strait being closed. But now, impairment in that route is going to drive, further fears and probably result in more risk premium being priced into oil overall. Because routing Gulf crude around the Cape extends the voyage by from 20 days to 48. Not to mention the fuel costs for sending a tanker around the Cape of Africa comes with it's the fuel cost is dramatically higher. So that means at port when it comes in, that oil is just simply going to be more expensive due to the shipping costs, without even considering the physical supply and the rest of it. And that's true for all imported goods to a degree. Libya's also now a problem. There've been a bunch of drone attacks. Now Libya's not a top 10 oil producer. I do think they could produce a lot more than they are, but the country's been factionalized since Gaddafi was taken down, and there was a drone attack on Zawiya, which is Libya's largest operating refinery. I think they do about 120,000 barrels a day, and is connected to the 300,000 barrel a day Sahara field. And Libya just got their national output back up to about 1.44 million barrels per day, which is the highest it's been since 2013. But obviously, this internal fighting and attacks on their main refinery would seriously hamper those efforts. So far, there's no outage yet, but it's a very, very fragile situation, and is only going to be escalated by higher oil prices, because both of these factions are trying to get control over the country's oil supplies, and if oil prices are going up, the incentive for them to try to wrest power from one another is dramatically increased. And then I think Ukraine also struck another Russian refinery today. So just all over the fucking place, we're losing infrastructure, and that's ongoing while the operating refineries globally are all running in the very high 90%, close to 100% capacity, if not just basically at full capacity. And then we're seeing refinery infrastructure taken down systematically, both in Eastern Europe and throughout the Middle East and Northern Africa now. And so globally, that starts to become a very serious supply disruption that's not easily solvable in the near term. And I think that's something that's also being priced into long-term rates. CoreWeave had a fairly interesting earnings tonight. They reported 2.58 billion of Q2 revenue, double a year earlier and slightly above consensus, with their backlog supposedly reaching 104 billion. Shares are up about 12% in after hours. This is they're treating this as validating compute demand, but I would say there's no serious argument tonight that customers have stopped using GPUs, but I don't know if they're using CoreWeave's GPUs specifically for AI. But CoreWeave is definitely a company that is being scrutinized heavily by private equity, since they have racked up substantial amounts of debt. Because if their backlog doesn't convert into cash, then the balance sheet will continue to accumulate financing costs and depreciation. And so the cost to finance the infrastructure, it's not really, do people want more infrastructure? Sure, it'll get used. But is the cost to finance it greater than the returns, right? Is the ROI on financing this infrastructure worthwhile? Apollo gained 6.2% and Blackstone 4% after joining NVIDIA's promised compute financing platforms. So, just another big fee pool for Wall Street. But it is bullish for like alternative asset manager earnings. And it means that like infrastructure risk is also spreading deeper into private capital rather than staying contained on like hyperscaler balance sheets. And that's a big risk problem for later. When all of this or if all of this fails to produce anything meaningful. Existing home sales fell another 1.7%, which probably didn't help things. Inventory declined 1.9%, and the median selling price still rose 2% to 434,100. First-time buyers accounted for only 29% of transactions. Lower price sales were weak, while activity above 750,000 grew at double-digit rates. So financing costs are clearly excluding marginal buyers, and wealthier households remain buyers of more expensive real estate. Their cash buyers are still in. 10-year around 4.7, so long-term mortgage rates sitting at their recent highs isn't a surprise. And so hot CPI would probably be followed by another long end sell off, which would further slow the housing market and make it more and more unattainable for those without the cash to purchase a home. Yen stayed around 159, but obviously tomorrow's CPI print is pretty much all that matters. The 10-year auction following that will be somewhat important, but it'll depend on which way it prints. And we're still not seeing any traffic through the strait, so it's still fucked. Regardless, you can just ignore the headlines until traffic actually resumes. On the chart side, we closed where we expected. A little bit of weakness. We kind of covered that at the beginning. Looks like here in the overnight session, back up around 77.33. So not much outside of today's intraday range. I would say bulls probably reset their levels down by 77.25. The 77.45-75 level will be pretty important on ES into the early morning. If that fails, that does open the downside move back to like 76.49, 76.36. And then, below that, we'd be looking for a breakdown of the trend. So a trend retest would be really where we're looking first, and then if that trend retest fails, we would be looking more to the downside for continuation. Oil looks like it's just up a fraction in the overnight, still below the intraday high, which was up at 84.61. Sitting at 83.44 right now. Not particularly impressive. It's not a big move, but we do have a toot signal, which usually shows continuation, and this is pressuring the short positions. The upside gap is not entirely filled yet. I think that closes at 84.67. I would say if that gap fills, given the enormity of shorts that came in on the gap down, it's very likely that this will start squeezing up, and that definitely opens up a closure of the upside gap, which is at 89.31. So that's quite a bit of range to the upside on oil if it starts to break higher. But this is like the first leg of the squeeze, the 78 to 84, and then 84 to 89 is the second leg of squeezing out the local shorts. And then you start to run into the longer term shorts that came in earlier during the conflict. And if those start to squeeze out, you're looking at oil above 100 a barrel. Again, rates at the long end, not really cooling substantially during the intraday, but down a little bit here in the overnight. Dollar flat Commodities still grinding higher. Gold fell back a little bit, easing, which we expected relative to the carry. Silver was pretty flat, down on the day, but flat here in the overnight. But precious metals still following through on the push up in energy prices. Correlation continued to break down today, and that's not a good sign. This is a mechanical underlying effect. If you guys saw the macro report, even if you're not a billionaire for this week, I kind of talked about this a little bit, but basically, as earnings pass and volatility on single stock names begins to crash, it incentivizes the buying of index volatility, which pushes index volatility up. And so, as the single name vol crushes, index vol goes up. And if the implied correlations start to rise, which they are doing, then you would start to look towards the nearer term signals of volatility. Like you look at VVIX and VIX. VIX down today, despite the lower close. But if we start to see VIX move, that's going to be a good indicator that the dispersion trade is probably falling apart. And generally, as we move into like the share buyback blackout period, and this period of the quarter, there's already like some mechanical pressure, and that's on top of inflation and yields and oil and everything else. And so also, correlations are at some of their lowest historical levels ever, and far from average levels, especially the 3 month. So if volatility were to like short volatility positioning in the market would start to break apart, it's probably going to break apart very, very rapidly because it's extremely over leveraged. Bond volatility up today alongside 3 month correlation. Those usually are correlated. Carry leverage flattening out, and forward yield on volatility tanking to one of the lowest levels we've seen since like December of 2025. And this is to give you an idea of how hard vol got shorted today into all this bad news that we got. And so you can kind of think of the forward yield on volatility as a little bit as like how much leverage is in short vol, depending on how negative it is. And so, obviously this is an insane amount of volatility shorting, and we know what happened after December. So a very similar setup in that regard. Gold fell negative a little bit, but bouncing right back. So not a steep decline into like more of a haircut on relative to the carry. But carry costs are flattening out. Generally speaking, if the cost of carry on the USD yen carry starts to go up, then gold would fall. But if it continues increasing, gold is likely to continue to rise because they're pricing in risk of de-dollarization and a failing dollar. And so obviously if you're getting more yen longs coming in, the cost to say short yen goes up. And then if people are expecting dollar to go down due to that, they're going to buy more gold to hedge their exposure to the dollar. Skewed down today 1.12%. Fed fund futures, not really anything interesting. The 210 up 2.16. And SOFR moved back up a point, sitting right back at the EFFR, neck and neck. Still not getting a big opening up in the front end like we were seeing in previous months. This is still staying very tight. If it continues to stay tight, like right around EFFR, IORB, into OPEX, then we might see some pressure or friction in front end financing again around that point in time. Forward yield on the correlation between VX and cash VIX, still moving more positive, but still negative. This is the futures roll because of the settlement, but this is starting to move more positive. And now with the Expiration passed, we may start to see vol actually move. Probably a lot of the vol shorting today due to trying to keep the settlement intact. Q's had buy volume largely today, despite their 60-point drop, and pretty decent volume at that. So that's interesting. So bulls just getting crushed all day, basically. Leverage flat on the day, which is actually really odd. It's almost never flat. And we pulled back to retest the 2024 trend. We failed it a little bit, but didn't close below it. So obviously this sets up a lower high, but this is not a confirmed breakdown yet. We get a confirmed breakdown under 76.98.15 on SPX. That opens up the move down towards like 7,600, and the gap fill to the downside. But we're not there yet, and I probably wouldn't want to even consider like shorting with any duration unless we fall through that floor first. I would say that hot CPI would definitely take us there though. And then sector wise, yeah, I mean, you had broader things moving. Producer manufacturing moved. Tech services sold back off, but then semis picked back up. So, still the same back and forth between those. I will say retail trade and health tech both fell off pretty hard today. But we are seeing more rotation again, with the exception of producer manufacturing. I think the seeing rotation into some of the smaller sectors and the defensives might be indicative of a sell off, at least by some parties, if not all. So this may broaden basically, like this like thinner positive breadth liquidation may broaden into broad liquidation. Vega puts are overpriced, but you could get them if you want to. It's just risky. They're not cheap. I mean, you're not the only one who wants them. So that I did recommend buying Vega puts like what 3 weeks ago or something like that, 4 weeks ago. All right, Pickles picks, and then I gotta get the fuck out of here. Oh Jesus, it's already 8 o'clock. All right. Fucking bitch. There we go. I'm traveling tonight, so I'm not going to be able to do the write up. So I'm doing them on here. There we go. And is Epic Pen working or no? Okay, cool. I'll get the vol report posted, like I said, over on the announcements channel for everyone. So we're just going to run through all of the indicators for tomorrow real quick. Not a lot of this is going to matter because everything's just going to be on the CPI print, but we can at least figure out range. So big structural support down here for the 0DT, moderate resistance up here at 7,800. Support down at like 75, 7650 and 7670. So obviously a pretty clean path for spot to the downside. And then that's the upside move. Those are one of most of one of those ranges is going to be realized probably before the morning is over, or before the market even opens. And then you got to pay attention to intraday positioning after that. On all expirations, there's still some positive gamma here, kind of helping float spot up. But as you can see, all of the supportive positioning to the downside is kind of eroded, which does mean if we fall, we can slip very easily, pretty much straight down to like 70. This looks like 7640 on all expirations. Is a slightly better support than 50, so we can extend what we just looked at on the other one. And then, same deal, except 7800 is a much larger resistance across all expirations out to the upside. The upside's obviously, a little bit more choppy. And I would say, it's very likely that a cool CPI report would probably open somewhere in here, like 7760 ish, and then grind out into the 7800 test, whereas like the bear side of this may just open low, and that's just because there's just more resistance to the upside move. Delta, we just want to look into the end of the week. Very, very thin to the upside. So if CPI is cool, almost all of the repositioning to the upside is going to need to be rebuilt to some degree. There's still a shitload of in the money calls way the fuck down in like the 7600 range. But we see, despite all the short vol today, a shitload of the in the money calls have gotten wiped out on today's downside move, which does kind of prompt things to continue down, maybe even regardless of the CPI print. This is shockingly thin positioning. We could extend this out to like OPEX and kind of look at that, and that's really fucking thin too. I mean, there's some interest out to like 7800, but that's pretty fucking gross. Um, and yeah, that's the next major expiration. On the charm side of things for tomorrow, it's already pretty bearish. I would say out above 7800 is a little bit more bullish. But it does look like charm's gonna be maybe out here. That's kind of bullish. Everything down here is pretty bearish until you get down around like that range, like 7580. So spot already, in a bearish position going into tomorrow's open. So if the market opens flat, there's going to be downside pressure as the day progresses. But opening lower and it gets more severe, all the way down to about like 7645, and more of this like 76 like 40 to 50 is looking like the downside target range for this move. Whereas 7800, 7770, 7775 looks like the range for the upside move. And gamma curve, we're up a tiny bit in the overnight, but the curve is steepening a little bit, but it's still very flat. So gains and losses in gamma, with each dollar price change are actually kind of thin right now. It is steepening a little bit, and you can kind of see the belly here is becoming a little bit more pronounced, and that does mean the gamma's starting to slide off a bit faster to the downside, but it's not crazy yet. I will say that a vol spike will shift this. So if there's a hot print and vol picks up, this is gonna start to look more like that. Like it's gonna get real steep to the downside, and gamma's gonna fall off a lot faster. So watch vol. Vol's gonna be very important. If vol crushes, the opposite, things will flatten even more. Dealer positioning, we got lower high, obviously GN, DN down today. So bulls still piling in on this drop, but DEXA overall still fading, and Delta still showing signs of in the money profit taking. So there's a lot of like at the money bulls, but the in the money bullish positioning is eroding, and it's been eroding pretty quickly since the fourth, since our high test. We've had a fairly consistent decline in both DEXA and Delta on the weekly chain. Gamma continued to drop, but remains positive at around 37.26 billion, which is significantly lower than where we were at the high on the fourth, which was 91. So we've lost, 60 billion in support of gamma going into the CPI print. And so even though the at the money bulls are positioning to stabilize this and still want the upside, um, they could still fail given the erosion in the money positioning. Right, this is like one of the like very typical scenarios where the in the money bulls rug the speculating bulls that are out of the money. Um, on the AM contract chain, we're still supported by Vega, but the trend is breaking down, and so this should be mean reverting back to Vega neutral, which is ironically right at our gamma target at 76.53. So that 76.40 to 50 range, it's right in there. And dealers will shed that delta until we retest VN, but then their books. Remember, VN tests tend to be very, very bouncy because their books flip back to a concave book or a convex book, and then when the convexity returns, the dealer starts, buying the downtick on gamma heavily because gamma is still positive at a test of VN, and you usually get a bounce. Now, if that bounce fades and you retest VN, then that can cause the dealers to collapse their hedges, which would lead to more downside, which we saw here, like back here. You kind of see us like you can kind of see this play out in longer time frames. I think risk may be too high for that this time, but like we got up above Vega, continued to Vega squeeze incrementally out higher and higher. Once the trend broke, we retested, right, and then bounced, and that bounce carried out to here in June, and then the next retest it actually failed, and dealers shed some of that delta, and that's when we got the bigger downside move in early June. The next one didn't really squeeze; it failed. Dealers sold their hedge off, right, and then we stayed range bound and under VN. VN continued to act as a support, pretty much from like end of June, all the way through August 4th, where we kicked off a little Vegas squeeze, but that looks like it's fading pretty quick. So it doesn't look as durable as these did. We don't have multiple consecutive up days off of that. So at least the Vega exposure isn't being added heavily. Dexa continued to trim here, but it's still much higher than it was at our most recent low. And Gamma's been pretty much flat the entire time, around 35 billion. So overall, if we look at both chains combined, we'll see that gamma neutral is continuing to rise, which is increasing the spread between GN and Vega neutral. And this is important because part of what enables a Vega squeeze on the index is the fact that gamma is positive. And as this period has passed, that amount of positive gamma has eroded, which inherently destabilizes the Vega squeeze. Vega's also, VN's also moving up, so short vol is trimming as well. It's just not trimming as fast as the positive gamma. And total gamma on the chain sitting at 71.98 billion, which is still very, very pinning. So until that gets washed out, we're probably not going to get like a big move. Well, we're going to take a look at that by expiry here now. So gamma actually flipped negative on tomorrow's expiration, which opens up more range, and we've been losing gamma on the near dated, like the next like 3 to 4 DTE contracts for several days now. If you just go back a couple days, you can see gamma, like where gamma was on, like for the 7th, for instance, it was at 12 billion. The 10th, the 11th was lower, so was the 12th, because this is where CPI is and the most speculation. But then rose back afterwards, and now you can see that those levels are significantly more eroded. Gamma on the 14th now down to like 4 billion. Gamma for the 12th now negative. And so we've lost quite a bit of that over the last few days. Anything under like 5 billion opens up much wider moves during the intraday, and you get a lot more realized volatility. Delta still positive locally, but very low. I think like the 14th is maybe worth watching a little bit. That was That was sitting at like 43 billion yesterday. End of day today, sitting at 35. So trimmed about 8 billion in Delta into the end of this week, and then like the August OPEX was at 258 yesterday, sitting at 245 today, so about 13 billion there. And then the September, which is the quarterly, was at 654 billion yesterday and is now at 613 billion today, which is that's actually a very significant drop. Almost 40 billion falling off on the quarterly contract. And for this to like really sell off, you want to see these delta on these quarterly and monthly expirations fall off harder than it is right now. Bears continued to add positioning. In the money put leverage rose across the board all the way to out of the money. We don't see far out of the money put leverage really declining at all. So sold puts down here where you see the peak of put leverage, but in the money puts being added and at the money puts being added. So put leverage totally up, but still contested between the two. This bearish rebuild, we saw this last night. We're seeing it again tonight. This is bears coming in and playing the downside. We also see call leverage rising, but it's out of the money and like not close out of the money, like further out of the money than 1.6%. Which is probably like something like the 5-day implied move for the index, which means these are calls being sold. And as you see, this rise and this fall, things get more bearish. We're not there yet, but obviously, if we slip down further, we're going to squeeze out all these short puts that are getting quite close to being at the money. And whereas these calls are likely to continue to increase that are being sold out of the money. And then call delta up, but only far out of the money. Call delta at the money down. I know this is hard to see, but if I mouse over it, you can see it. So like call delta down like 0.10 trillion at the money. And then more so here. So a very small drop, but bullish positioning backing off, bearish positioning building. I will say that the delta increases on puts are mostly far out of the money. Now those could be speculative, like people betting on hard downside move, and the delta increases on puts near the money is very thin. So the bearish rebuild is not super strong or anything. But if these are being bought, and then spot moves down, then the delta on these is going to increase massively. Calls price down a tiny bit. It's very hard to see. It's like almost imperceptible. Not a big deal. And puts priced up far out of the money, but the at the money puts are roughly the same as well. So just like a little bit more bearish rebuild, but not a lot. And the bulls don't really seem to be backing off at all. They're not adding, but they're not removing positioning, which is kind of what you can derive from tonight's. This is particularly interesting. I'll cover vol over on the Discord, but I did want to pull. Obviously, there's a shitload of event vol for tomorrow. We're not anywhere near there. Oh, I need to switch this to SPXW. Yeah, shitload of event vol for tomorrow, so that'll get crushed out if where is this? There we go. Right there. That'll get crushed out if the CPI print is kind of lackluster. But there's also like a decent amount of event vol priced into Thursday and Friday as well. It's not really till next week that the event vol falls off completely. So, CPI, PPI, and then probably Michigan consumer keeping the event vol elevated here. Skew continued to turn up on the SPXW 30-day, so a little bit more bullish there. Options are cheap relative to their realized, so probably some call buying there on the 30-day window, and then in the 10-day window, we've got just skews way the fuck up here, but after the pullback yesterday, it's just flat day over day. Options here are also still cheap. Now, particularly because skew is up, puts are exceptionally cheap, and that might be why we're seeing the bearish rebuild, just because the put pricing is advantageous right now. 76-point implied move for tomorrow, which I'll pull up the other chart here in a second. I just want to find out what the SPX implied move is real quick. 58. So that gives us like 60, 67 points for tomorrow. I think 134. Yes, 67 points for tomorrow. So that should be our range, and we'll see how that's priced relative to the realized volatility. So tomorrow's like 67. So options are pretty fucking expensive going into tomorrow. This is a Monte Carlo sim. It basically creates oh shit, you guys can't see it. Sorry. Ooh, I'm glad I caught that. Okay, so this is like a Monte Carlo sim. It basically just creates a distribution of possible price targets based on the X number of prior sessions price action, and then weighted to the front. So they're not super complicated. This is like a randomized distribution, but weighted relative to, I have it weighted relative to the prior price action. This is saying we're roughly pretty flat on the day, right? Or roughly pretty flat over the next 5 days. But given the wide range of distributions here, obviously there's a lot of potential outcomes. Tomorrow's range should be a little bit thinner, at least based on what we have historically for the last, I think, like 20 sessions. Yeah, I think I have it weighted at like 20 sessions. So that tells us that these are very overpriced. A flattish print would probably lead to vol crush, and then options are overpriced until we get out to like 77.80 to the upside, and then like 76.75 to the downside. I really don't want to indicate one for tomorrow because I don't know what the CPI print's going to be. It should be hotter, but the last like 4 prints, they've changed their formulation tables like almost every time in order to hedge off different sectors that have been running just hot as fuck. So I wouldn't be surprised if like something like core wasn't showing up as strong. And if core is weak tomorrow, that's what everyone's going to be paying attention to. If core is weak and doesn't suffer any significant pass through from PPI, then that's going to trim yields at the top end. But if core is hot, this is going to just plummet. So I mean, there's really no point in like drawing like an expectation. But I would say that like 76.50 to the downside, like a full return back to Vega neutral, very likely, and then out to the upside, maybe 78.05, 78.10 on a really cool print. And then I think vol's priced up enough that if it's a fairly flat print within expectations, or if it's like flat with like headlines a little bit hotter, maybe, then everybody just crushes all the vol and we wait for PPI tomorrow, which is usually how that goes. And then if PPI is hot, we just get a repeat of today. And I think that covers everything I wanted to cover for Pickles Picks. So I will see you guys tomorrow. Have a great night. Keep an eye on market opening price. I would say below 7,700 bearish, above 77.50 bullish. It should be a pretty easy way to gauge where we're going to end up. And that's it. So have a great night, guys. Later.